A very good morning, everyone. This is Professor Shyam from LJ Integrated MBA. Today, we are going to be continuing forward with our series on videos of basics of financial risk management. In last video, we saw the basics of risk management and other things such as loss, perils, hazards. Right? Today, we are going to be looking into what are the general types of risks that any individual or an institution or an organization faces. Not wasting much time, let us move forward with our videos. The first one is individual risks. Right, as the name suggests, individual risks are confined to individuals, right, or smaller group of people. Um, Events such as theft, robbery, which are more particular to a human being or very much specific to a person, can be included over here. Some of these risks can be insured, right? You can prepare in advance for the losses that you may incur or that you may have to face because of being exposed to such individual risk. An example is you can buy a theft insurance, right? If you live in areas where theft or robbery is common, then in order to save yourself from losses emerging because of theft in your house, you can always purchase a theft insurance. Another type of risk, as the name suggests, is group risk. As the name would tell, or as the name indicates, it is more wider in nature and it affects a bigger group of people. A risk is said to be group risk or fundamental risk if it affects the economy or its participants on macro basis, right? So if any risk has wider effects on uh, the society or its people, right, it can be considered as group risk. They are impersonal in origin, right? And also in consequence, right? The effects of this group risk are wider spread in nature and are usually or affect in common, right? They affect most of the social segments or the entire population, right? If a country enters into a recession, all of the people residing in that country would be affected. If a war is going on in a country, right, all of the section of their people would be affected by war in one or another way. Group risks are usually socio-economic or political or natural calamities, right? Earthquakes, flood, war, unemployment, or any other situation. So recently, what happened in Switzerland, where there was a huge landslide, while it affected a small section of people, but it had impact on a very large scale. So it can also be considered over here. The recent examples would be the unrest, the civil unrest that happened in Manipur, right? Because of ethnic issues over there. It affected a very large population of residents or citizens of India residing in the state of Manipur. Then we have pure risk and speculative risk. Pure risks are insurable while speculative ones are not. We will look into this as we move forward. Right now, let us move forward to static risks. Static risks are those risks which are more or less predictable. Right, they have constant level of occurrence and are usually not affected by economic conditions. Right, common examples of static risk would be fire damage to the property or theft of personal belongings or uh, accidental injuries while doing routine activities, right? Static risk might also include natural calamities or risk emerging from natural calamities such as rain, thunder, or lightning, right? We already know that when it comes to rainy season, there is always a risk that it may rain harder in your area, or there might be larger phases of thunders, or there might be instances where lightning has struck your nearby area. All of these risks are more or less predictable and can be understood very well. Then we have dynamic risk. As the name would suggest, it is dynamic in nature and would keep changing, right? And usually it results from changes in economy or the environment in which an economy operates, right? Dynamic risks are more emerging and may have different impact on every single section of the society. Right? Macroeconomic variables like inflation, income, and output levels, technological changes are dynamic risk. Imagine what happened to India's telecom industry when Reliance Jio entered. Right? They changed the entire technology, and the entire telecommunication industry of India was in trouble. If inflation increases in any country, it might have long-lasting and deep impact on every single section of people residing in any country. Dynamic risks emanate from economic environment and hence are difficult to anticipate and quantify. Inflation also have some of the characteristics which cannot be quantified directly. Right? Inflation may have a larger impact on middle class, a very large impact on lower middle class, and there is also a possibility that inflation might also affect the rich class of the society. So they are difficult to anticipate. That is why it is more dynamic and hence it cannot be quantified. Then there are quantifiable risk and non-quantifiable risk. As the name would suggest, quantifiable risks are risks that can be quantified, which can be given a number or which can be estimated, although the accuracy of estimation might vary, but yes, there is some figure or number that can be attached to the same. Right? Financial risks are usually quantifiable risks. Say, for example, losses that you may have to face from investing in shares or mutual funds. Risks which cannot be quantified, which are qualitative in nature, are considered as non-quantifiable risks. Situations like tension, stress, or any physical or mental problem, especially mental problem, which cannot be quantified. If I am being harassed by someone, it cannot be quantified. It also differs from person to person. So those are qualitative risks in nature which cannot be quantified. Now we move forward to the section of pure risk and speculative risk. Like pure risk are those where there is a possibility of loss or no loss. Please understand that there is no gain to any individual or an organization in pure risk. If I am traveling from one place to another, I might face an accident or I might not face an accident. If I face an accident, if I have an insurance policy, I can file for the claim. If I don't face any accident, it's fine, right? I am in a no loss or no gain situation, right? Please understand there is no gain when it comes to pure risk. If I have not faced any accident, that's fine. I do not gain. Say for example, I have purchased a term insurance by paying 5,000 rupees for 1 year. If nothing happens to me in the time period of 1 year, my 5,000 rupees is gone. I cannot claim it back from the insurance company because I have not faced any adverse consequence. Then comes speculative risk. Speculative risk are those where there is a possibility of gain plus loss, right? So you can face a situation where you might gain or you might have to face losses. One thing to note over here is the element of gain is inherent or structured in a situation, right? The simplest example of speculative risk is indulging in investing in shares. If you invest in shares of any company, you might gain from increase in the prices of the shares of the company. And the opposite may happen too. Once you have invested, the share prices might fall, resulting in a loss for you. So pure risk are those which can be insured because there is a possibility of loss or no loss. Speculative risks are one where there is an inherent element of gain. And when it comes to insurance, they do not allow us to gain from insurance. And hence, speculative risk cannot be insured. Pure risk have a deeper impact on an individual or an organization, while speculative risk may have some positive effects on the economy or the individual. So that's it for the day. We will meet again in the next video and we will discuss about pure risk versus speculative risk and the typical examples of pure risk in detail. Thank you. Have a nice day.